My name's Craig Earlham, Senior Market Analyst at Oanda, and today we're going to talk about WTI crude. Now, oil markets have very much attracted a lot more attention over the last few years. The supply cuts which we've seen from OPEC nations in order to offset a declining oil price has been very well publicised. The emergence of the US as the world's largest oil producer has very much contributed to this. Shale oil has been the major factor within this, and what we've seen is the US producing oil at much lower prices. Now what this does is it fills the market, it brings prices down, and it's forced the OPEC nations and some non-OPEC nations, including Russia, to actually cut production in order to try and artificially lift prices. Now, we saw an example of this a couple of years ago, a few years ago now, and that seemed to stabilise prices back towards those kind of $70, $80 levels. Now, since then, we've seen more US oil coming online, and that has actually led to prices dropping. We've also seen global growth concerns contributing to that also. So what we heard back at the end of last year is that the output cuts, the production cut agreement amongst OPEC and non-OPEC nations has been extended into this year. And that's been really pivotal for prices of WTI. We've seen it bottom around just close to $40 a barrel. Now, prices actually continue to fall after the announcement, but I think that was very much exacerbated by holiday period, low levels of volume, by the sell-off in the stock markets, and therefore risk appetite. We have to remember that aside from production or supply and demand, the dynamics that is typically a massive driver for oil, it's also very sensitive to risk appetite, especially risk appetite that's linked to global growth. The fact that people were fearing a global growth slowdown in 2019 naturally is going to weigh on demand, which is why it hit prices so hard, and that was exacerbated again by those lower volumes. We've seen a strong bounce back since really since Boxing Day, Christmas, just the period before Christmas and the brief period after Christmas, around about where we actually saw a bottoming in these prices. We have seen a rebound off of these levels, which coincided with a rebound in equity markets. And since then, we're trading around 25% high, but now that we're hitting a really crucial level, I think, from a technical standpoint, because as you can see on the chart here, we've got an inverse head and shoulders. Now, the terminology sometimes gets confused amongst traders, and some people buy into it and some people don't. But I think we have to look at what the important point of this inverse head and shoulders is. For one, we've stopped making lower highs and lower lows. So that downward trend looks to have reversed. We've then made a series of higher lows and higher highs, which suggests we are seeing at the very least, a corrective move. Now, if we see a breakthrough $55 or that kind of region, again, we're not dealing in specifics here, but around the $55, $56, if we see a breakthrough there, that takes us above previous highs, it takes us above previous support levels, which suggests that sentiment has very much changed since those levels were broken. And what people like about things like inverse head and shoulders is it gives you possible price projections. It gives you a conservative possible price projection, which is typically measured by the size of the move from the shoulder to the neckline with the level which we're potentially looking at breaking now, and then projected higher, or the more aggressive possible price projection, which goes from the head, which lies around the kind of $42, $43 levels, to the neckline, which again is around that $55, $56 projected higher. Again, these are just textbook moves. This obviously is not trading advice, but it gives you an idea as to why people are viewing these levels as being potentially so bullish, because a breakthrough here would suggest that the market is forcing us through these levels because they're extremely bullish. So I'm very much keeping a close eye on this. We may not see a breakout initially, but as fears around global growth start to recede, as we have seen them do, if the equity market rally can be sustained, that could be the bullish catalyst which really takes us through these levels. Also, we have to consider that OPEC is cutting output. That's going to start to materialize and take its toll on global oil inventories, as we've already seen. And we're also seeing the rig count in the US falling. We saw it fall by another 15 rigs last week. Now, this again suggests that crude coming out of the US is shrinking because of these lower oil prices. And that, again, offsets some of that supply-demand dynamics, which again is typically seen as bullish for prices.